Good morning, ladies and gentlemen, and welcome to Cepsa's fourth quarter and fiscal year 2020 results presentation. This is Gonzalo Sáenz, Cepsa's Head of Finance. Today's presentation will be conducted by Salvador Bonacasa, Cepsa's CFO. But before we begin, please let me take a moment to flag that financial information contained in this document is unaudited and certain figures are non-IFRS. This webcast, including the Q&A session, may contain forward-looking statements. These statements reflect the company's beliefs, intentions, and current expectations concerning, among other things, the company's results of operations, financial condition, liquidity, growth, and strategies. Forward-looking statements are not guaranteeing of future performance of the company. Please take a moment to read the disclaimer on the first page of the presentation. You can send us your questions through Slido during the presentation. To do so, please go to slido.com and enter the passcode showed on screen, Cepsa Results. You may post your questions at any time during the presentation, and we will make our best to address them at the end of it. I kindly ask you to please identify yourself when posting your questions so that we may refer to you when addressing the answers. So, as we said, today's presentation will be conducted by Salvador Bonacasa, Cepsa's CFO. And without further delay, please, Salvador, the floor is yours.
Thank you very much, Gonzalo. Good morning, ladies and gentlemen, and thank you for joining us today for Cepsa Q4 and full year 2020 results presentation. This is Salvador Bonacasa, Cepsa Chief Financial Officer. First and foremost, we hope that you and your families, friends, and colleagues are all in good health given the current circumstances. In today's presentation, I will be taking you through some key highlights of the fourth quarter and the full year 2020 and provide you with some reflections on what has been a quite challenging environment since March, with the COVID-19 pandemic impacting to some extent all companies in all sectors. Let's start our presentation with our Q4 2020 highlights. Firstly, it is worth highlighting that during the whole period since the onset of the COVID-19 pandemic, our priority has been to protect the health and safety of all our employees, clients, and suppliers, while ensuring the continuity of our operations to guarantee the supply to essential energy products and services to society. Operations have been running smoothly during the quarter, with all key assets and industrial plants operating normally. In this last quarter of the year, we have seen improved performance in almost all of our business sentiments. Upstream registered higher production with the crude oil prices in the $40 to $50 per barrel range. Refining margin was stronger during the last quarter of the year in comparison with the previous one, although refineries run rates have been adapted to softer demand. Marketing business was slightly impacted by the new travel restriction put in place during the last month of the year, especially in Spain. Lastly, our chemical business continues to outperform, delivering value to Cepsa and society at large, being the first producer of linear kerosene, LAB, worldwide, utilized in detergents and hygienic products, which are extremely important these days. In terms of financial performance, Cepsa has generated an EBITDA of 277 million euros during the quarter, 1,187 million euros for the full year. This reflects the company's ability to perform this despite the challenging market environment. Cepsa also posted a positive operating cash flow of 218 million from October to December, in line with third quarter metrics. Cepsa continues to hold a remarkable liquidity position, which at the end of the year exceeded 4.6 billion euros, and a long average debt maturity of 4.4 years. It's worth highlighting that the company reduced quite significantly the dividend payments for the year to 166 million euros, which represent a 63% decrease versus 2019, evidencing its commitment and the commitment of both shareholders to conservative financial policies and investment-grade ratings. At the start of the COVID-19 pandemic, and in response to the deteriorating market and economic conditions, Cepsa put in place a contingency plan with a range of actions aimed at protecting cash flow generation for the year. This plan resulted in cash savings of 527 million euros as of December 2020, exceeding the initial target of 500 million. Finally, in terms of corporate events, Cepsa and Unity completed the first corridor of the largest intercity high-power charging network of the Iberian Peninsula between Madrid and Barcelona, evidencing a step forward in the energy transition. Moving on to slide number 7, you may see the evolution of the main external variables that affect our business: oil price, refining margins, euro-dollar exchange rate, and automotive fuel demand in Spain. Oil price stabilized in the $40 to $50 per barrel range during the fourth quarter, averaging $44.2 per barrel. At present, however, prices have rebounded and are now at around $65 per barrel, fact which should have a very positive effect in our upstream business in the first quarter of 2021. Refining margin improved during the fourth quarter, increasing to an average of $2.5 per barrel from their minimum levels in the last 10 years that was registered during the third quarter, 0.5. The sharp increase of the oil price during the first quarter of 2021, however, has put renewed pressure on it. As per the euro-dollar exchange rate during the fourth quarter, we saw the US dollar gradually depreciating versus the euro, continuing the trend initiated in Q2. Finally, automotive fuel demand was impacted mainly in October and November due to the new travel restriction in Spain, lifted to some extent during the Christmas season, leading to a relatively good figure in December, as you can see in the slide, -3% only. In the slide number 8, you can see a comparison of key operational financial figures in Q4 versus Q3. In general terms, all key metrics except for net income have remained at very similar levels to those registered in the third quarter. This fact demonstrates the strong resilience of Cepsa business models, given that during Q4, the third wave of COVID-19 infection translated in a slowdown of economic activity and new travel restrictions. Realized crude price improved slightly from $42.6 per barrel in Q3 up to an average of $44 in the fourth quarter. In refining, production and utilization rates of our refineries were adapted to the softer demand, with 2 units of La Rábida refinery being under extended maintenance turnarounds. These units will resume productions as soon as demand recovers. Marketing product sales in the quarter were 3.6 million tons, which represent a decrease of 5% compared with Q3, mainly derived from the lower demand in October and November and its impact on our network of service stations. Finally, chemical product sales, which were already strong, remain at similar levels of those registered in the third quarter. Moving on the financial metrics, we may also see similar figures to the ones reported in the previous quarter, consolidating the positive trend that began in Q3 and despite the still volatile external environment. CCS EBITDA was 277 million euros during the quarter, in line with Q3. Net income in the quarter decreased to negative 29 million euros, mainly due to increases, taxes and depreciations. Cash flow from operations remained in line with Q3, proving Cepsa's ability to generate positive flows in the most challenging circumstances. Lastly, net debt in the quarter decreases slightly versus the end of the third quarter, standing at similar levels versus the end of 2019, mainly due to the contingency plan put in place at the start of the crisis and the company efforts on working capital management. Cepsa liquidity position remains strong at 4.6 billion as at the year end. Moving to the next slide, we would like to briefly comment the COVID-19 impact on the performance of each of our businesses during the quarter. Regarding the upstream business, COVID-19 has had a limited operational impact to date, apart from the decrease in production levels driven by OPEC quota restriction, affecting mainly our operations in Algeria and the Emirates. As we mentioned before, crude oil prices have stabilized during the third quarter and fourth quarter in a range between $40 and $50 per barrel, while production increased during the quarter. EBITDA generated by the upstream business in 2020 was 458 million euros. Moving on to refining, we must highlight that in such a challenging market environment, Cepsa refining businesses has demonstrated operational flexibility and the ability to optimize margin and adapt swiftly to market demand. As such, we have been able to partially mitigate the depressed market refining margin, which during Q3 registered their lowest level in Europe on the last 10 years. In Q4, however, margins improved to approximately $2.5 per barrel. As previously discussed, 2 units of our La Rábida refinery in Huelva saw extended maintenance work carried out during the quarter due to softer demand. This unit, however, are ready to resume production as soon as demand recovers. Despite the difficult market environment, refining generated positive EBITDA in the year of 10 million. Moving on to marketing, COVID-19 has affected very differently the business segments within our marketing business. For instance, we have witnessed significant drops in demand for aviation fuels, especially affected by the well-known demand situation in the tourist segment mainly, but other segments such wholesales and asphalts have performed quite strongly. As per the network of our service stations, the volumes in the last quarter of the year were impacted by new travel restrictions, although margins have held up remarkably well, partially offsetting by lower demand. 2020 EBITDA of the marketing business amounting of 400 million. Lastly, in our chemical businesses, COVID-19 pandemic has had a positive impact in all business segments, especially linear alkyl benzene. LAB is used as raw material for detergents which are currently in high demand. Volumes during the quarter have remained stable, with the plants operating at full capacity. Margins have remained solid in all segments. The global leadership positions of our chemical business segments and their resilient nature have proven to be a competitive advantage in the current market environment. In fact, chemicals registers a record year with EBITDA of 357 million euros. In the slide number 13, we want to talk about the contingency plan. Cepsa put in place a contingency plan at the beginning of Q2 to protect cash flow generation and strengthen the balance sheet. The plan has been completed, delivering results ahead of expectations. Accumulated savings at the end of the year amounted of 527 million euros, clearly exceeding the initial target of 500 million. In the graph on the right side of the slide, you can see the split between CapEx and OpEx. We continue to work on optimization opportunities of the company working capital, releasing 156 million euros in cash during Q4. Finally, taking advantage of the historically low commodity price during the second quarter of 2020, we hedged a relevant portion of our energy costs for the year in our industrial plants, and we have used available storage capacity to profit from crude contango trades. In terms of financial initiatives, I would like to highlight our efforts to further improve the company liquidity position during the year. In this sense, since March, we have executed new committed banking facilities for a total amount of 1.1 billion euros. We have accessed to debt capital markets twice with two 500 million bond issues, which achieved large oversubscription. And we have reinforced our liquidity position to a total of 4.6 billion euros and extended the average debt maturity profile to 4.4 years. Moving on to slide number 14 on short-term outlook. We would like to review this the short-term market outlook. For the first half of the year, we expect a gradual recovery of the economy and demand in sync with advances of the vaccination campaign in Europe. In upstream, we expect oil price to remain stable in the range of the $60 per barrel. Production is expected to grow in sync with the lifting of the OPEC quotas and the oil demand recovery. In refining, margins are expected to remain under pressure in the near term due to the subdued demand and the sharp increase of oil prices seen in the last few weeks. Refineries utilization expected to remain at similar levels in the short term and to gradually increase as economies reopen. In marketing, as volumes are more directly linked to travel restrictions, we expect this to gradually recover as restrictions are lifted, especially from the second quarter. Margins to remain healthy in line with previous months. Finally, in chemicals, we foresee a strong performance to continue in all business segments, especially LAB, with no material changes in margins in the near term. Now, let's move to the results for the full year. We can pass to the next slide, please. Thank you. 2020 has demonstrated that Cepsa businesses diversification provide a substantial benefit in challenging and volatile environments. The strong performance in the chemical business and the resilience showed in marketing have partially offset lower earnings registers in upstream and refining. In global figures, Cepsa has generated clean CCS EBITDA of 1,187 million in 2020, with all the businesses registering positive EBITDA in the year. Cepsa also posted a positive operating cash flow of 881 million euros in the year, with additional 138 million euros being released from working capital. CCS net income stood in positive territory, reflecting the company's ability to perform despite the challenging market environment. Regarding the operating performance for the year, On one hand, we saw upstream production decreasing as a result of the OPEC quotas, minus 18% year-on-year basis, as well as lower refinery utilization, minus 11%, as production was adapted to market demand. On the other hand, however, we saw marketing performing remarkably well and chemicals registering a record year, demonstrating the strong resilience of these two businesses. Finally, taking a brief look at the corporate events of the year, we would like to highlight the following one. Cepsa investment grade credit rating were affirmed by all three rating agencies post-COVID. In February and July, Cepsa successfully completed 2 bond issuance for 500 million euros each, achieving a wide oversubscription. This issuance allowed Cepsa to reinforce its liquidity position while improving the average maturity of its debt. In June, Cepsa signed a partnership deal with Majalin Holding Group to jointly develop two asphalt business in Morocco and capitalize on synergies. Through this agreement, which allows Cepsa to continue growing its business internationally in priority areas such as North Africa, we acquire a 40% stake in two leading companies in the Moroccan market for the production and distribution of asphalts. Finally, Cepsa signed an agreement with Unity for the installation of electric charging points at its service station in Spain and Portugal. Under the agreement, Unity has started to develop a network of ultra-fast chargers within Cepsa service stations, making it the first operator with this kind of charger in the Iberian Peninsula. Focusing now on the group's operating performance in the slide number 17. The working interest production was 75.8 thousand barrels oil equivalent per day, compared to 19.6 in December 2019. This decrease is due to the already mentioned OPEC quota restrictions affecting both Algeria and Abu Dhabi fields. Realized crude oil price in the year was $41.6 per barrel, 35% below 19 levels due to COVID impact on worldwide demand. A slight increase in upstream OPEX per barrel from 9.9 to 10.2 due to the different mix in production as a result of OPEC's quota restrictions. In refining, Cepsa refining margin indicator stood at $2.5 per barrel versus 4.3 of 2019 as results of the decrease in the demand for oil products due to the COVID-19, which led to narrower middle distillates and gasoline crack spreads, and light to heavy crude oil spread also. Utilization rate of the refineries stood at an average of 78% during 2020, adapting to the lower in demand. Marketing product sales decreased by 29% to 14.7 million tons as a result of the travel restriction in Spain during the most part of the year. In chemicals, product sales have been slightly below, although improved margins in all segments have translated in a record year in terms of results. Lastly, natural gas sales decreased by 7% due to the slower economic activity. If we move over to slide 18, we wanted to share with you the financial highlights of 2020. Despite the impact of the COVID-19, which was particularly acute during the second and fourth quarters of 2020, cost savings put in place and our business diversification have proven the resilience of our businesses. In terms of EBITDA generation by business unit, we have seen very different performance across business units. Upstream was particularly impacted by COVID-19, with the EBITDA decreasing by 52% year-on-year, as a result of by lower realized crude prices, minus 35%, and lower production, minus 18% due to OPEC quota restriction. At free cash flow level, however, upstream is somewhat less affected. Upstream accounted for 39% of group EBITDA as of December 2020. Refining registered 10 million euros of EBITDA during 2020. This figure shows a drastic decrease versus the previous year due to the depressed refining margin environment, minus 41%, as well as lower production, minus 12%. Marketing EBITDA was less affected, down only by 14%, as lower demand was partially affected by improved margins. Marketing accounting for the 34% of group EBITDA. The last one, chemicals, registered an EBITDA of 357 million euros, up 45% versus 2019. In which has been a record year for the business, with a very strong performance of all business segments, in particular LAB. Chemicals accounting for 30% of the total amount of the group EBITDA. Corporate costs were down 19% year-on-year basis as a result of cost-saving initiatives related to the contingency plan put in place. With regard to other key financial metrics, clean CCS net income amounted only 1 million, impacted by the low crude oil price environment, depressed refining margins, and decrease in demand due to COVID-19. IFRS net income was negative in 919 million euros as a result of impairments registered in the upstream and refining businesses due to the deteriorated market environment caused by COVID-19. Cash flow from operations before changes in working capital was 881 million euros, which shows Cepsa's ability to generate positive cash flow even in the most challenging market environment. Investment in the year amounting 652 million euros, decreasing 29% versus 2019 as a result of the saving initiatives included in the contingency plan put in place to preserve cash flow generation. Moving on to slide number 19 on cash flow generation. As previously discussed, cash flow from operations before working capital variation stood at 881 million euros in the year, a 50% decrease versus the 2019. On top of this, and as a result of a number of optimization initiatives, working capital variation released 138 million euros in cash during the year, for a total cash flow from operations slightly above 1 billion. CapEx payments in 2020 amounted 774 million euros, with main investment being related to the development of upstream assets in Abu Dhabi, a number of projects efficiency in the refining and chemical business unit, and to a lesser extent, the acquisition of a 40% stake in the two asphalt companies in Morocco. As a result, Cepsa generated a positive free cash flow in 2020 of 260 million. Let's now move on the next slide in order to discuss about our capital structure. Cepsa maintains a robust balance sheet with net debt before IFRS 16 liabilities of 2.8 billion euros as of December 2020, relatively flat versus the last year. and a net debt to EBITDA ratio of 2.7 times. Following the onset of COVID-19, Cepsa has focused on reinforcing its liquidity position and on terming out a number of its short-term facilities. As a result, as of year-end, Cepsa held a very solid liquidity position comprised of cash on balance sheet and available committed credit facilities of 4.6 billion euros. This figure is enough to cover the maturities up to September 2025. Now, taking a closer look at our debt maturity profile on next slide, thank you. I would like to flag the following. With the maturity extensions executed up to December and the long 8-year and the long 5-year bonds issues in February and July, the average maturity of the debt currently stands at 4.4 years. Cepsa holds a relevant cash position, which at the end of the year stood at 1.4 billion, with total liquidity understood as a cash plus available committed facility of 4.6. And to finalize today's presentation, I would like to say a few words about on ratings and dividends. As already mentioned, Cepsa investment grade ratings were affirmed by all three rating agencies post-COVID at BBB-, Baa3 and BBB-. At this point, I would like to emphasize that maintaining investment grade ratings is a key priority for both Cepsa and its shareholders. And in that respect, the company will continue to observe conservative financial policies. In this sense, and as a clear evidence of this commitment, in 2020 the company reduced very significantly its dividend payments to shareholders by paying just 166 million euros, representing a 63% reduction versus the amount paid in 2019. Well, and with this slide, we conclude today's presentation. But before moving to Q&A, I would like to say that we are cautiously optimistic about the future, which with probably the worst part of the COVID-19 pandemic behind us, and the advances on the vaccination program showing its first results. In addition, from a financial point of view, we have significantly strengthened the liquidity position of the company and termed out debt maturities, and therefore believe we are very well equipped to cope with any future uncertainties. Our diversified business model has also proven to be quite solid and strongly resilient in these challenging circumstances. For further details on Cepsa results, I encourage you to refer to the press release and quarterly report which will be published on Cepsa website right after this call. Thank you very much for your attention and all the best for all of you. Thank you very much.
Thank you very much, Salvador. We will now move on to the Q&A session. So please let me remind you that once again how you may direct us your questions. You may go to slido.com and enter the passcode showed on screen, Cepsa results. Once on the event page, you may type your questions in the dialog box. I kindly ask you to please identify yourselves so that we may refer to you when providing answers. Many thanks. Okay, so we have a number of questions from Anish Guha from Eaton Vance. First one is regarding refining margins, Salvador, and our 2021 guidance for refining margins. What do we expect for 2021?
Well, you can understand it's very, very difficult to do some accurate prediction about what will be the refinery margins and other magnitudes for the company. But we understand that in this environment that probably could show some volatility in the next weeks or months, the expected refinery margin would be under pressure in the next months. But we expect that the average level of margin for the first half of the year should be higher than the registered in 2020, probably more than 10 or 15% higher.
Okay, thank you. The next one also from Anish.
There is a second part of the question, no, about
Yes.
the shutdowns, and if we expect to shut down any units. Well, just now, as we mentioned before, we have a utilization rate of the units in the refineries plants of very close to 80%. And well, just in the very short term, we expect to maintain more or less these utilization rates, not closing any or not shut down in any other additional units, and expecting to recover this production when the demands will be higher in the next months, probably after in the second quarter.
Okay, there is a couple of questions on the energy transition plans and our expectations in that respect, and the M&A appetite of the company.
Well, the company planned to have a presentation, to do a presentation about the strategy and the main focus on the strategy in the coming months. And I would prefer to wait to this presentation in order to say something new about this new strategy of the company.
Okay, thank you. Then we have a couple of questions from Simone Mittal at Schroders. Production and CapEx guidance for 2021 and dividends. The dividends, we have a number of questions as well on dividends policy and expectations on dividend payments for 2021.
Well, about production, we are very impacted by the decision of on OPEC, because the main fields that we have from a production point of view are located in Algeria and Abu Dhabi. Well, it depends on the quota restrictions, would be more or less affected in this part. The second was about the dividends, I understand?
CapEx guidance for
CapEx.
2021.
Well, our budget shows that our CapEx will be in a very similar level than the amount of CapEx that we spent in 2020. There are no big difference between one another.
And lastly, on dividend guidance for 2021.
And about dividends, as we mentioned during the presentation, our shareholders and the company is very committed with the investment grade and is very sensitive to be prudent in order to pay dividends. In 2020, the dividends figures was 166 million euros, and depend on the evolution of the profit and loss account and the robustness of our balance sheet. We can pay more dividends or not, depending on the decision of the board of directors during the year. No?
Okay, thank you. We have a final question from Oliver Woida. Leverage levels are outside the rating agency's requirements. How will you secure to reach the required levels, and how much time is given by rating agencies? Okay, let me take this one. So in terms of leverage ratios, you're correct. We are outside the required thresholds. However, as you've seen, the debt has remained virtually flat versus 2019, so it's a matter of obviously the EBITDA decreasing, no? As has been the case for the whole industry. We have made efforts in terms of, capex deferrals, in terms of opex cuts, dividend payment cuts, as you've seen, in order to, to protect the cash flow generation. And for 2021, and depending on how the COVID-19, situation evolves, we expect already to be back complying with the thresholds. Okay, or at very close level to those thresholds. Nevertheless, as Salvador mentioned, we are both at the company and shareholders strongly committed to investment grade ratings, and so we will take decisions and actions in order to secure those and continue to defer capex or cut costs as required. One new question from Simoni in terms of production guidance. We expect it to be flat or lower compared to 2020. I guess you already said that, no? So depending on OPEC quota restrictions and how those evolve, but currently we see it flat more or less versus 2020 at similar levels. Okay, there are no further questions. So with this, we conclude today's presentation and Q&A. Thank you very much, everyone, for attending, and take care. Bye-bye.